Okay, student, as I told you, right, I will continue capital budgeting discussion in this video clip also, right. Uh, I will discuss a full question, complete question. Uh, I choose the question from 2019 past paper of AMA, right. It's question number 1. Let me to read out the question. Right? Ensika Contractors, a company engaged in supplying machinery for housing projects, is presently evaluating 2 different projects. However, finance is available to invest only in one of them. Right? That is the important point. They have fund just to invest in only in one project. So the cash outflow and the cash inflow have been given, not the cash inflow. Net profit after tax from year 1 to year 5 of both project has been given. Right? At the end, he is telling that machinery used for project A can be disposed for rupees 10 million at the end of the project period, which means after the 5th year, at the end of the 5th year. And the machinery used for B needs to be replaced at the end of 3rd year, right, during the lifetime, because project B is having 5 years lifetime totally, right. At the end of the 3rd year it has to be replaced at a cost of 20 million. Value of machinery used for B would be nil at the end of the project. The company uses straight line method for depreciation, and the company's cost of capital is 15% per annum, right. So A part, what is required, right, you are required to calculate NPV, IRR, payback period, and also accounting rate of return. That is the A part of the question. The B part of the question, advise the company to select the most viable project. The most viable project. Okay, right. Let me to do this question in the Excel, right. I have already I have already done this question in the Excel, so let me to explain it, right. Okay, first let's take the project A, right. Initial cash outflow is, initial investment is 35,000, right. All figures are in the 30 short form, right. 35,000 is our cash outflow. Second information is given is net profit after tax, right, where we, in order to find out the cash flow, right, project cash flow, right, we need to adjust based on the scenario, right, or based on the information given in the scenario, right. In this question he has given some information about depreciation, which is the non-cash item to be adjusted in this question, right. Therefore, first let's do the depreciation adjustment, right, to find out the net received, right. Net profit he has given in the question. For the first year 7,500, second year 9,000, again 10,000, 16,000, 9,000. So I have put it here. Okay, the other point is depreciation. We know depreciation is equal cost of the asset minus scrap value if available upon lifetime of the asset, right. That is the formula we simply using, right. According to the information given, for project A, 35,000 is the initial investment, which means it's the initial cost of the machinery minus scrap value. He is telling 10 million, okay, upon lifetime is 5 years, right. So straight line method of the depreciation, policy is applicable for this project according to the question, right? Therefore, for each year we have to paste 5,000. Okay. When we are calculating the net profit, we would have deducted depreciation. We would have deducted the depreciation and we would have found net profit. What we discussed, depreciation is a non-cash item. Therefore, it should be added back to find out the net receipt. Let me to take another color. Okay. Right? So, you add net profit plus depreciation, right, for each year, get these values. This is the net receipt. Right? So what I will do, I'll paste all this net receipt here, right? I'll take the same color. So I paste it here. Okay. Now you can identify the net cash flow. I'm sorry. Right, year 0, right, when you are making the investment, it's cash outflow, there is no value, right? It's no value, right? Therefore, net cash flow is 35,000 minus. Right, year 1, the same value will continue, year 2, year 3, year 4, year 5, right? 10,000, that is the scrap value we deducted here, right? Machinery used for project A can be disposed. Then it's going to be another income, right? Is going to dispose it. So we have to add these 10,000 with the net receipt 14,000. Then it will be 24,000. Okay. There is no tax adjustment, right? Now we have found net cash flow. Right? Cost of capital, company's cost of capital is 15%. Right? So these values 12,500, 14,000, 15,000, 21,000, 24,000, all these are to be received in future, year 1 to year 5. Therefore, what we have to do, we have to convert this value into present value. That is the discounted cash flow. That is the meaning of discounted cash flow. How can we do it? As we discussed in the previous video clips, right? We have to adjust with the discounting factor. It means the cost of capital percentage, right? You know, at the year 0, the value will be 1, right? From year 1 to year 5, right? How can we calculate this discounting factor? How can we find it? Using the table also you can do it, right? Otherwise, you can put this 1 over 1 plus r to the power n. You can use that, right? 1 over 1 plus, right? R means 15%. To the power of n. N means the year, right? Year 1, year 2, year 3, year 4, year 5. Okay, right. I have taken these values. Okay. Yes, my formulas are correct. Yes. Then I will multiply this net cash flow into discounting factor. you will end up with these values. Right, now you can find the NPV, net present value. How can you find it? Right, these all are, I mean year 1 to year 5, these all together cash inflow which is to be received in the future. Altogether it is 55,257.38, right? From that we have to deduct the cash outflow, right? Then you can find the net present value, which is 2257.38. 2257.38. Okay, right, this is project A, this is project A, right? This is done. Moving to project B, right? Its initial cash outflow is 30,000, right? Therefore it is a minus value. And again here also you have to find out net receipt, right? Since in the question he has given net profit after tax value, you have to find out the net receipt. Here same way you have to apply, because only the tax only the depreciation information has been given, right? So net profit, this is net receipt. Okay, I'll take the color. Net profit, net receipt. Net profit is given 2,000, 5,000, 16,000, 18,000, 20,000, right? Depreciation you have to find out. Here what is telling, at the beginning they are using a machinery, but at the end of the third year they will replace another machinery. So therefore depreciation, depreciation is equal cost minus scrap value upon useful life, right? For machinery 1, right, 30,000 is the initial investment, right? There is no scrap value because there is no such information regarding the scrap value, right? What is telling, value of the machinery used for project B would be nil at the end of the projects. Yes, there won't be any value, right? At the end of the third year also it is replaced, there is no value, right? Salvage value. So therefore it's 0 upon 3. Per year you get 10,000. For the replaced machinery, right, they are investing 20 million, right? So the cost is 20 million upon minus no scrap value, so therefore it's 0 upon 2 because it is used only for 2 years. At the end of the 5th year there won't be any value, therefore it is also 10,000. So just paste it 10,000, right? As I explained to you in the case of project A, here also net profit, with the net profit we have to add back the depreciation value to find out the net receipt, right? Okay, right. So the net receipt value of project B is 12,000, 15,000, 26,000, 28,000. At the end of the year 30,000. So just I'll paste this value, right? Okay, right. Now we have to identify net cash flow, right? Here also at the end of the third year again they are investing 20,000 to replace with a new machinery. Therefore, it's a cash outflow, so that should be taken into account. Okay, so net cash flow amount will be minus 30,000 at the year 0, right? 12,000, 15,000, 6,000, 28,000, 30,000, right? As I explained to you in the project A, right, you have to adjust the net cash flow, right, by the discounting factor value, right? You know how to find this discounting factor value, right? At the year 0 it's 0, again it's 8.70, right? 756, 658, 572, 497, 0.497. Okay, if you multiply net cash flow by the respective discounting factor, right, you get this value, right? 30,000 minus, again this is the cash inflow, totally 56, 646.43. if you deduct 30,000, you get the NPV value of 26,646.43. okay, so this is the answer for the A part first question, NPV of both project, right? NPV of both project. Right? Second part, you have to calculate IRR. In order to calculate the IRR, what you should know, right? You should apply this formula. IRR is equal L plus L mean discount rate of the load trial plus P mean NPV of cash flows of the load trial, right, upon again P minus N mean NPV of cash flow of the high trial into H minus L. H is equal discount rate of the high trial minus L is equal discount rate of the low trial, right? So therefore you have to identify